This is a hidden expense most business owners don't budget for.
Let's talk about how to prevent these surprises.
Let's get fiscal. Let's get fiscal. Make it make sense. Money moves smarter when the numbers click.
Welcome back, guys. What are we talking about today?
So I wanted to go over self-employment taxes.
Oh, fun.
I know, because that's kind of the sneaky hidden tax that is really the true cause of a lot of these surprise bills.
Yeah.
So,
So where do you even begin?
Well, I think what are self-employment taxes is a good spot.
Am I supposed to be doing this?
What is it?
So what is a self-employment tax?
So it is the Medicare and Social Security contributions. But since you are both the employee and the employer, you have to pay both sides. So when you are a W-2 employee, you still see a deduction for Social Security and a deduction for Medicare. But you are only paying your half, and then your employer is paying the other portion. But when you are self-employed, either sole proprietor, single member LLC, partnership, S-corporation, really all of that money is going to be coming out of your one bank account.
Yep.
Both sides of it. So a lot of times, it's not unusual for maybe the income tax to be $1,000 and it's nice and easy. But then you have self-employment taxes that comes in at $8,000. And then now you have a nice, pretty healthy $10K bill for making probably not a lot of money. So that is where a lot of the surprises come from and where we need to make sure that we save money. And I would, while this is kind of self-employment taxes, I would still say that it's beneficial for S-corporation owners to have the same consideration. Obviously, it's going to be decreased because they're only needing to pay the Social Security and Medicare on their reasonable compensation and not the full profit of the business.
Yeah.
But ideally, once their profit of the business was greater than the reasonable compensation and they were a single member LLC, they converted to an S corporation.
Yep.
So now, and that's one of the things too, is, when you're moving from a sole proprietor or a single member LLC, and people say move over to an S corporation. Well, if your LLC is making the same or less than your reasonable compensation, the S corporation structure is not going to save you money because the Social Security and the Medicare tax is still going to be exactly the same amount.
Yeah. Yeah.
So, so that's why I say it's, even if you are an S corporation or even a C corporation, because C corporations still have that reasonable compensation requirement for all of their owners or employees. So it's still something that needs to be considered at every level of self-employment. If you are running your own business and you would like your business to pay you something, or you would like to use some of those business earnings for personal items like your groceries or your rent, then we need to take into consideration the self-employment taxes.
Gotcha. Is it something that someone could calculate on their own, or is it really only when you're you need to go and talk to someone and just make sure that you guys are doing it? Yeah.
It is something that can be calculated on your own. It gets a little bit trickier because it's based off of the profit of the business.
So you do need to know what your business financials are looking like. Yeah.
Right. Yeah. So if you are doing your bookkeeping really consistently, you know what your business use of home deductions are, you know about your car mileage, everything is really documented and kept up to date. I mean, every single month you could kind of be planning out how much self-employment tax do I need to save for this month, or what did I earn kind of last month, what have you. But a lot of times everybody's just really busy.
Yeah,
and there's not enough time to be able to do that. So what can be easier is to just take a percentage of your what we call it, your gross revenue. So whatever you brought in without taking into account any expenses. And then that way you still have, basically a year to figure out what are business expenses and what aren't business expenses, because especially if you're a sole proprietor or single member LLC, you're probably commingling.
9 times out of 10, yeah.
You know, not all of your expenses are nice and pretty in one bank account. Maybe you've accidentally used your personal credit card for something or what have you, so then now we get into a situation where it's a little bit more complicated to figure out what your actual profit is every single month and kind of in real time. So in those scenarios, I just recommend, especially if it's going to be really super fast paced, just base it off of the money that you're bringing in. And, then that becomes like our worst case scenario.
Yeah.
So the worst case scenario is this is how much money you owe. But ideally, what we're also doing is creating a bucket where your taxes will be lower. You have a little bit of a nest egg just in case the business needs it. I mean, like a fifth case scenario if the business needs it, because we don't want to eat into this tax savings more than what's necessary. And then also we're doing your retirement savings.
Yeah.
Because if we're drilling down your Social Security and your Medicare so that you don't have a big bill there, you also get fewer benefits when you retire. So, and that's another reason why everybody's like, oh, I never want to make money and I never want to pay taxes and I never want to do this. And it's like, okay, but when you're 75 and you can't work, you're going to get $100 check and that's all you have to survive, or is the plan to just work forever? There has to be an exit strategy. Some kind of reasonable standard of living that, again, a business should be able to support you into retirement versus a job is something that you have to do forever. But a business will actually become its own entity that can support you in kind of those later years. So that's why I say, even if it can be a much larger dollar amount, if that means that now, your tax bill is cut in half, but we have an extra $10,000 that we can put into retirement, like we can put money into a SEP or a Roth or a traditional IRA or open a solo 401k, something like that, or you're just kind of building your own tax refund at that point in time. So in a traditional setting, they are withdrawing the money as you're earning it because the IRS, the U.S. system is pay as you go, not pay as you want to. Unfortunately.
They want their money now.
So when you have a W-2, they're already taking money and
every
it's
paycheck,
based off of your gross income, and then they're setting it aside for you. You file your return, claim all of your deductions, and then you get a refund back. So, with a business owner, you're able to, kind of create that bucket yourself. Yeah. And then kind of based on what's happening with the business, then you can kind of go one way or the other. But a lot of it too, it's going to be based on, do you have historical financials that we can look at? Do you have a forecast of what your spending is going to be? Because I know we work with some like very equipment heavy businesses. So if I said, hey, save 25% of your top line revenue, that's going to be a big hit for them because they're already operating, a lot of businesses, the traditional sense is like a 50, 30, 20 split. So 50% goes to servicing.
Oh, okay.
The contracts, 30% goes to running the business and then 20% goes to you as the business owner, so if you're saying like, okay, let's take 25% off of the top, then basically like that doesn't leave a lot of profit for you if you're operating at a 50%, gross profit margin. So, knowing some of those numbers can sometimes be helpful. But I kind of default to a 25% model, just 25% of whatever your top line is, because most of the time, you're going to have 15% in your Social Security and your Medicare costs. You're most likely going to fall in the 22 to 24% tax bracket, plus you'll be like 7 to 9% in California. So it's going to actually be a lot higher, but your effective rate will probably fall in that 25 to 30% range. But again, that's also, we're not even considering any expenses. So if you kind of take a quarter of your income and you set it aside somewhere, then you really are able to build a lot of these other financial goals. So like I said, you're building your retirement savings fund, you're building a regular emergency fund, and you're building your tax savings fund. And so what our goals are kind of, okay, out of that 25%, try to make sure not all of it goes right into taxes.
Like how can we allocate this a little bit, but still benefit you?
Exactly.
Would you suggest that people have a completely separate account that it goes into? Like keep it kind of separate? Okay.
I mean, normally I'm always recommending a high yield savings account that's held at an institution that's not related to your normal banking at all. So number one, I want high yield savings so that we earn a little bit of interest while it's kind of sitting there, because we know even if you have to pay your quarterly estimated payments, you still get it to sit in and earning a bit more interest than like the 0.00.
It's so low.
Nothing, and so if it's over there, it's earning interest, but then it's also kind of that out of sight, out of mind principle. It's really going to force you as a business owner to operate within the limits of what you actually have available to you. So that's also a consideration to make.
It's just not easy access to it. That's fair.
Right.
Maybe even do it like an automated thing. Just like, okay, just a certain little portion of this comes out.
And I mean, you can... let's say if you already know, because estimated taxes are based on what you made in the prior tax year. So if you already know what you made, what you had to pay in taxes last year, you can just start paying them, and you can pay the IRS every 2 weeks. You can pay the IRS every month. There's nothing that says that you have to pay them only on these quarters. You can send them more payments. It's just the quarters or the minimum payments, or you're paying them through payroll at a certain point in time during the calendar year.
Yeah. Okay.
So
that makes sense.
But especially when you consider, 25% of your income, that's a big deal.
Yeah. That's a lot.
And if you are a small business owner and, let's say, again, you're living in LA and the profit of the company is only $30,000, but that's basically nothing for renting an apartment and having a car and all of these other things. So even if the business is profitable, because then you're going to turn around and have this, fairly large tax bill, it's not going to create enough space for you to be able to have the income that you need to survive.
Yeah.
So really being aware of that and knowing that is coming down, because then you can either adjust your lifestyle, adjust your strategy, just all kinds of other things. It's when it's a big surprise. And like I said, you've been living off of $40,000, but you have a $25,000 tax bill. That's a massive hill that you need to climb, and a lot of pressure to be able to get to those points. So it's better to just kind of be aware that this is happening. And it's like one of the biggest, like the toughest pill to swallow, just because it's that idea of following your dollars, So when you have a W-2, like none of it's real. Yeah. It doesn't, you like get your first paycheck and you get angry the first time, but then you just like kind of adjust and adapt to whatever that is. But then once somebody gives you the full amount, you have so much lifestyle creep that kind of comes in, and then you're adjusting to that upwards number. So you just need to make sure that you don't allow that to happen so that you can really protect all of the other items. And like I said, 25% is a large dollar amount, but with good tax planning, it doesn't all have to go to the IRS.
Yeah.
And I think that's kind of the key.
Very helpful. Like have your money working for you a little bit with you were talking about like with retirement funding and things like that. So that's a little bit like I'll get that eventually. Yeah.
Right.
It's not going to the nether and then never to be seen again. Yeah.
Right. But I mean, I think like they say, taxes are for business owners one of their larger expenses each year. So just even recognizing that and planning around that is going to be a really big thing that prevents a lot of these like big surprises or like I said, like going freelance and then you're like, okay, well now I have this like, I don't know, sometimes it's like $75,000, $100,000 in taxes because you didn't pay for 3 years because you were fighting your way through. And that happens a lot. And so if you are going into the situation knowing all of that, it makes it a lot easier. And then you don't, you're not afraid of the business growing and you're not kind of catching up to some of the different things that are sitting out there.
Yeah. Nope, I think that makes complete sense. I also think because we work with majority creatives that we usually are just don't have it be touching. Like just don't have access to it. Don't do any of those things because it'll be like, oh, just a little bit here, a little bit there. And be like, no. This is to help you later on, I promise. Yeah. Because it is nice when when we get to have the calls with the client and they're like, okay, I put away this much. And you're like, great, this is where it's at. Now we have this little extra. Like it's a way better conversation than when we get someone first and you're like, I'm really sorry, but you are going to end up owing this, that, and the third. So it's nicer for us too when people have been able to plan ahead and get that kind of going in.
Right. Exactly. And I mean, like you said, we have people and they're just like, I went to this tax preparer and they said that I owe $20,000. And I'm like, well, you owe $20,000.
I hate to break it to you. Yeah. But now here's how we can maybe prevent that or plan better for it. So that way it's not a surprise. Because I'm definitely an out of sight, out of mind person. Like I love to be prepared and I love to not have to think about it. So having those, I don't know what that is. Oh, is that a bug or is it fuzz? It is a bug? Okay, we'll just let it be.
Wings. Yeah.
It's got wings? Okay. Sorry about that. I like to be prepared for things, but I also need to not know that something's available to me too. So it's nice when it's just that's just that little bucket that we don't really ever look at. So it's coming to you.
So if you have any questions about how you can prepare for these taxes, what they really mean for you and your business, and any questions, just basically, what is this and why do I need to go through these processes? Feel free, send us a comment, shoot us an email. However it goes, we are here to talk all things tax. We'll talk to you later.
Bye.
That's it for this episode of Let's Get Fiscal. If this helped you see your business differently, follow or subscribe on your favorite podcast platform so the next episode is already waiting for you. And if a specific money question came up while you were listening, send it through the link in the show notes. Real listener questions help shape future episodes. You can also follow Let's Get Fiscal on social media for more tax tips, business finance breakdowns, and clips from the show. Until next time, keep building the business behind the work.